The vegetables are way too expensive. Cucumbers are 12 yuan now. Why does it feel like things that we can still afford are going up in price, while the things we can't afford are getting cheaper? Just a while ago, vegetable prices hit their highest point in almost 10 years. Cucumbers used to be 2 yuan per kilo, but now they've increased sixfold. Green beans, bok choy, and tomatoes have also doubled in price. Even instant noodles have gone up by 50 cents. And high-speed rail, water, and gas in some places are also getting more expensive. Vegetable price hikes are mainly due to the heat and rain affecting supply, reducing the quantity. Another reason is that they're trying to boost consumer spending. Everyone knows that consumption drives the economy. Even when prices of essential items rise, we have no choice but to buy them. This spending leads to profits for businesses, which then invest or raise workers' wages. This creates both consumption and employment. But the problem is that while we notice prices going up, we don't see wages rising, which is really frustrating. This woman's comment highlights that raising prices to stimulate consumption often doesn't work as expected. While higher prices may lead to profits for businesses, if consumers' purchasing power doesn't increase, it can actually stifle demand. People may cut back on spending or switch to cheaper alternatives, which can have the opposite effect.
8块钱一斤的黄瓜
Cucumbers are 8 yuan per kilo, ginger is 9 yuan, and eggplants and green onions are priced unusually high. This has led many to say that vegetables this year are simply unaffordable. Some even accuse farmers of being unscrupulous, exploiting the poor weather to charge exorbitant prices for quick profits. However, is the sharp increase in vegetable prices truly due to farmers taking advantage of the situation? Prices fluctuate daily. Are natural disasters the cause, or is there someone manipulating the market behind the scenes? In reality, if you visit the main vegetable producing areas, you'll find the production levels have only slightly varied, and logistical disruptions have been brief. So why do prices surge 5 to 10 times by the time the vegetables reach the markets and supermarkets? Can farmers really influence this?
This man's comment suggests that although farmers play an important role in vegetable pricing, they often have limited control over the final market prices. The spike in vegetable prices is likely due to deliberate market manipulation. China's economy continues to decline, with a severe real estate crisis and soaring unemployment rates, all of which are seriously affecting people's lives. At the same time, the government's excessive money printing has led to rising prices. Recently, Shanghai's produce prices have matched those in New York, drawing attention from the public. Recently, vegetable and pork prices in mainland China have significantly increased. Pork prices have been steadily rising since January and reached 17 yuan 80 per kilo by July, surpassing 20 yuan per kilo by late August, a very noticeable increase. At the same time, data from the Ministry of Agriculture and Rural Affairs on the wholesale prices of 28 key vegetables showed that on August 21st, the average price of these vegetables reached 6 yuan and 13 cents per kilogram, up 12 cents from August 15th, and more than 43% higher than mid-June prices. This is the highest price during this time of year in nearly a decade. A former city official from Shanghai district in Shanghai, Yan Weiying, said in an interview with NTD that the price of vegetables in Shanghai has doubled. For example, cucumbers that used to cost just a few yuan now sell for 8 or 9 yuan. Most vegetables are now around 10 yuan, and even green onions, which used to be given away for free by vendors, are now about 11 yuan. The price hikes are significant. She mentioned that last year in Shanghai, she had to spend 20 yuan to buy a loaf of bread, 40 yuan for a cup of coffee, and parking fees were around 20 yuan per hour. Breakfast almost cost her 100 yuan. If she dined out for dinner, the average cost was around 200 yuan per person. So the cost of living in Shanghai is very high, yet the average income is not. Although the official figure shows that the average income in Shanghai is 12,000 yuan, the number is skewed. In reality, wealth and income are unevenly distributed, with most people's salaries remaining around 6,000 or 7,000 yuan, which is closer to the true income level. Friends have mentioned that it's difficult to even pay for groceries, not to mention paying off home and car loans. Senior journalist Shi Shan said that the cost of living in Shanghai has already reached that of New York, including common commodities and even rent, which is quite surprising. We once believed U.S. incomes and prices were much higher than China's, but now Shanghai's prices have matched New York's, while incomes lag behind. Senior journalist Guo Jun believes that the price increases over the past 2 years are a direct result of excessive money printing. Although the CCP claimed to not flood the economy with stimulus stimulus measures in the past 2 years, in reality, China's money supply has exceeded that of other countries. This is effectively a flood of stimulus, and excessive money printing inevitably leads to inflation, driving up prices. China's economy is facing significant challenges, particularly the debt held by local governments. In August 2023, Goldman Sachs estimated that China's local government debt had reached 94 trillion yuan, which includes hidden debts from local government financing platforms. As local government finances continue to deteriorate, many localities are increasingly relying on issuing bonds to alleviate their debt crisis. According to Chinese government data, in the first 7 months of this year, local governments issued about 4.2 trillion yuan in bonds. Of this, approximately 2 trillion yuan was used for refinancing and 2.2 trillion yuan for new bonds. Refinancing bonds are primarily used to repay the principal of maturing government bonds or existing debt, essentially borrowing new to pay old. From this data, it's clear that if you add the newly issued 4.2 trillion yuan in debt to the existing 94 trillion yuan, local government debt would be nearing 100 trillion yuan. Guo Jun pointed out that this year, China's local government debt issuance is mainly covering interest payments. The reason why government debt is such a major issue is because China's economy is entirely controlled by administrative power. Economic decisions, monetary policy, and fiscal policy are all determined by China's administrative departments, with no checks or balances from the People's Congress or the Chinese People's Political Consultative Conference, let alone other societal supervision. Government debt results from fiscal policies, and since the government controls the money supply, the easiest solution is to print more money. Guo also identified 2 problems distorting prices. First, a large portion of the overissued currency has been absorbed by the real estate sector. Additionally, China's economic model ensures that overissued money does not reach consumers but goes into production. This stems from the inertia of China's planned economy, which focuses on production rather than consumption. As a result, overissued money leads to significant overcapacity, worsening China's structural economic issues instead of generating a positive economic cycle. The second problem is that price fluctuations caused by monetary expansion spread from the center to the periphery. This means that those who get their money first benefit the most. In China, these are the government and institutions closely connected to it, particularly financial institutions. The effect of monetary expansion only trickles down to the general consumer sector later, and the price increases we're seeing now are a result of this process. Reports from Chinese media show that by the end of March, China's broad money supply, M2, had reached 305 trillion yuan, an 8.3% year-on-year increase. Narrow money supply, M1, was 68.6 trillion yuan, a 1.1% increase year-on-year, and cash in circulation, M0, reached 11.7 trillion yuan, an 11% increase. In the first quarter, 377 billion yuan in cash was injected into the economy. Regarding the broad money supply balance, or M2, Zhou Lan, director of the Monetary Policy Department of the People's Bank of China, explained at an April 18th press conference that the current balance of over 300 trillion yuan reflects years of financial support for the real economy. However, financial analyst Cai Shenkun, a former top contributor on Phoenix News Media, argued that the rapid growth in M2 is closely related to excessive money printing. The government has printed so much money to maintain GDP growth, effectively competing with the world by rapidly issuing yuan to sustain high GDP growth. Nonetheless, the effect of M2 increase to China's economic development has been increasingly questioned. In an article last year, Ren Zeping, chief economist at Zhongyuan Bank, pointed out that since 2022, M2 has grown rapidly, but GDP growth has lagged behind. For example, in 2022, M2 grew by 11.8% compared to the previous year, while nominal GDP grew by 5.3% and real GDP by only 3%. In 2023, M2 grew by 12.7%, but nominal GDP only rose by 5%, with real GDP increasing by just 4.5%. These figures suggest that M2 growth has far outpaced GDP growth, with limited positive impact on the economy. The Chinese government has also noticed the potential problems with fast M2 growth. This year, the rate of M2 expansion has slowed compared to last year. According to China's state media CCTV, M2 growth has dropped from 12.7% in the first quarter of last year to 8.3% in the first quarter of this year, with further slowing to 7.2% by April. CCTV reported that this suggests monetary policy is returning to normal. However, Zhang Jie, a former branch manager at a Chinese commercial bank, told Radio Free Asia that the CCTV report actually shows that China's monetary policy has not been normal. The government has never admitted to overissuing currency or acknowledged that the speed of money printing was abnormal because they claim that China has no inflation, or at least that inflation isn't severe. Now they're talking about returning to normal, which suggests that they're aware that their monetary policy has been abnormal. Over the past 2 years, there have been continuous warnings of deflation in China, which seems to support the government's claims that there is no inflation. In early April, China's National Bureau of Statistics reported that the Consumer Price Index rose by 0.1% year-on-year in March, down 0.6 percentage points from the previous month, and fell by 1% month-on-month. Meanwhile, the Producer Price Index dropped by 2.8% year-on-year. These figures continue the slowing trend from last year, with ongoing warnings of deflation. This has left many puzzled. On the one hand, M2 supply continues to grow rapidly, but on the other, consumer spending and production expenditures are growing at a much slower pace, leading many to ask, where has the money gone? Tsai explained that people are reluctant to spend money. People's incomes haven't actually increased, so they have less money and less confidence in the future, leading to decreased purchasing power. At the same time, the real economy has not yet picked up, and the production in the service and industrial sectors has not truly recovered. Tsai emphasized that much of the money issued by the government hasn't actually returned to the real economy, leading to significant issues of capital idling. One sign of this is the high level of bank deposits. He said if you look at the deposits of households and companies, they're very high. However, corporate deposits are mainly concentrated in state-owned enterprises, central enterprises, and government-affiliated institutions. Tsai pointed out that a large portion of the newly issued money hasn't been used for production, but instead has been absorbed by government debt. This money has gone back into the government through corporate and local government bond issuance. Often, the government uses these funds to pay off debts, including interest owed to banks and maturing debt. He added that the troubled real estate sector has also absorbed a significant amount of money. So despite the abundant money supply, there is still a shortage of funds for real economic activities. Although deflation has appeared in the past year or two, the continued rapid growth of M2 has raised inflation expectations. In recent months, many areas have seen price hikes for water, electricity, and gas, signaling possible inflation. Recent reports have shown that even the three essentials of the poor, pickled vegetables, instant noodles, and beverages, have seen price surges. Tsai commented that given the rapid increase in M2, price hikes for basic necessities are inevitable. Guo stated that starting this year, the government will have to adjust prices in major areas related to the economy and people's livelihoods. They want to instill a sense of urgency among the public, making them realize that holding on to money will make it worthless in the future, forcing people to spend. Guo Jun mentioned that foreign experts have often advised the Chinese government to distribute the newly issued money directly to the public and regular consumers. While this makes sense from an economic perspective, it doesn't align with the logic of the CCP system, as the Communist Party's authoritarian regime is essentially a wartime machine, where production capacity matters more than market price mechanisms. Guo explained that production capacity determines military strength, not consumption or price signals, so the CCP leadership's priorities differ from those of Western experts. Guo Jun further added that the duration of China's economic crisis will depend on the CCP's willingness to wage war. If they plan to engage in military action against Taiwan and prepare for large-scale warfare, their attitude towards economic management will follow suit. If they aim to resolve the current crisis and shift towards a more market-driven model, it could take over a decade to stabilize. However, if they stick to the current state-controlled model, the allocation of resources will remain distorted. In other words, if they continue on the same path, the economic crisis will deepen until the system eventually collapses. Guo believes that the CCP will maintain the current administrative control over the economy because they are preparing for war. China's ongoing economic slump has worsened the government's fiscal situation. On August 26th, the Ministry of Finance announced that general public budget revenue for the first 7 months of the year reached 13.6 trillion yuan, down 2.6% year-on-year, a decline similar to the first half of the year. Meanwhile, government fund budget revenue fell to 2.3 trillion yuan, an 18.5% drop compared to last year, indicating that the decline has accelerated. General public budget revenue consists of tax and non-tax revenue. Data from the Ministry of Finance showed that tax revenue for the first 7 months was 11 trillion yuan, down 5.4% year-on-year, which contributed to the overall 2.6% decline in general public budget revenue. According to the Chinese media outlet Yi Cai, Luo Zhiheng, chief economist at Yuan Securities, explained that the drop in tax revenue is related to the slowdown in economic growth forms the foundation for tax revenue growth. When the economy slows, tax revenue is constrained. Additionally, falling prices, particularly for energy and mineral products, have weighed on tax revenue growth. Specifically, the largest tax category, domestic VAT, fell by 5.2% year-on-year in the first 7 months, and corporate tax income decreased by 5.4%. Conversely, domestic consumption tax, the third largest tax category, grew by 5.5%, driven primarily by the increased production and sales of refined oil, cigarettes, and alcohol. However, personal income tax dropped by 5.5%, reflected by the mid-2022 policy of increasing special deductions for personal income tax and a significant drop in income from property transfers. Stamp tax revenue from securities trading reached 57.6 billion yuan in the first 7 months, down 55% year-on-year. Real estate-related taxes, including deed tax and land value-added tax, continued to decline, reflecting the persistent downturn in the real estate market. The real estate slump has also led to a sharp decline in local government land sales revenue. In the first 7 months of this year, revenue from the transfer of state-owned land use rights amounted to 1.8 trillion yuan, down 22% year-on-year. According to calculations by Bloomberg, local government land sales revenue in July plunged by over 40% year-on-year to 250 billion yuan, marking the steepest decline since comparable data became available in 2016. To make up for lost tax revenue, non-tax revenue has grown rapidly. Data from the Ministry of Finance showed that non-tax revenue in the first 7 months reached 2.4 trillion yuan, up 12% year-on-year. Non-tax revenue accounted for 18% of general public budget revenue, an increase of 2.4% from the same period last year. Chinese media outlet Jiemian News reported that in the first half of the year, at least 16 provinces saw non-tax revenue exceed 1/3 of the general public budget revenue. Non-tax revenue mainly comes from the use of state-owned assets, administrative fees, and fines. Luo Zhiheng from Yuan Securities noted that in recent years, local governments have turned to revitalizing state-owned assets and other measures to cope with a tight fiscal situation, driving the growth of non-tax revenue. Bloomberg, based on data from the Ministry of Finance, calculated that combined spending from the general public budget and government fund accounts reached approximately 19.7 trillion yuan, about $2.8 trillion in the first 7 months of the year, down 2% from the same period in 2023. Local governments have been cutting spending as their budgets are strained by the severe real estate downturn, which has discouraged developers from buying land. The impact of the real estate crisis on public finances has become increasingly evident on the balance sheets of debt-ridden local governments. Bloomberg estimates that the broad deficit, a key measure of the fiscal gap, has reached 3.8 trillion yuan. Analysts believe that the ongoing real estate crisis, fierce competition among companies, and the sluggish job market have hurt the confidence of both businesses and consumers, making it difficult for domestic demand to recover.